Hi there, and welcome to Trading VIX Options, Trading Volatility, Hedging and Trading Strategies. We're going to cover a lot of material. So before we get started, basic disclaimer disclosure. Just be aware we are an education company. We are not a financial advisor, nor do we play one on TV. So any ideas discussed in this presentation are illustrative and not a recommendation. So let's talk about me, my favorite subject. My name is Mark Sebastian. I am the founder of OptionPit.com. I was a floor trader for near a decade, and then in the last 5 years, I started OptionPit. OptionPit works with retail and institutional clients. We have clients with as little as $1,500 sometimes, and we've had institutional clients with $15, $16, $20 billion. So I like to say we can help you whether you've got $1,500 or $15 billion. And often the group with 15 billion knows less than the group with 1,500 is always the interesting piece. But that is what I am about, and that is our goal is to teach people how to trade like professionals. So what you're going to learn what is volatility, what is the VIX, what are VIX options and futures, what causes VIX options to move, some things on VIX ETPs, ways to trade VIX, and ways to use VIX to hedge. Right. Volatility is a measurement of movement of an underlying instrument over a period of time, regardless of direction. Right. So you'll hear things like variance and standard deviation. What makes volatility different is that it is for it's set over a period of time. A season, a year, you name it. The higher the volatility, the higher the movement and or expected movement of the underlying. When we discuss volatility, no matter how long to expiration, the number is an annualized number. So when I am talking about any type of volatility, that is an annualized number. That is the key. There are three main types of volatility traders look at. Historical volatility. Historical volatility is how much an underlying has moved in the past over a set number of days. We look at 10-day, 20-day, 30-day, 60-day, 180-day historical volatility. Then there is realized volatility, and sometimes realized and historical will be used interchangeably. I look at realized volatility as how much an underlying is moving right now or in the absolute immediate. Then finally, we have implied volatility. All right, implied volatility is how much the market is expecting an underlying to move over a set future period of time. So when we look at implied volatility of an option, that is the market's best guess at how much the underlying is going to move. So if Apple has a volatility of 30 on a particular strike of a particular expiration month, that is an annualized number of how much the market thinks Apple is going to move between now and when that contract expires. All right, so what makes trading volatility different than trading a stock? All right, and here's the big thing is over the long term, we know where implied volatility of a stock or index is going to go. We do not know where the price of the stock is going to go. Apple can go up and up and up and up. All right, it can go up and up and up. And the thing to understand is that implied volatility mean reverts. What is the range of volatility? Any stock or option, it can go as high as it wants. That's the key. A lot of people don't understand. Volatility, while it is mean reverting, can go as far and high as it wants to, and it can go as low as it wants to, but it will eventually revert back to a mean. So let's just really briefly look at, this is a stock chart of Apple. As you can see, doesn't really look like there's any true pattern there, does it? Just kind of going up and up and up. Meanwhile, VXAPL, which is the VIX of Apple, that has, you can see, obviously it does move around some, but if I pull this back enough, this, we could put a 1,000-day or a 1,500-day moving average, and it would be almost dead flat. Apple volatility is pretty stable. So is VIX. So is every single volatility. Volatility is mean reverting. Recently, we saw, I can remember times where Apple would go to 50 volatility, and I can remember times, as you can see on this chart, where it was below 20. All right, so let's talk mean reversion. All right, so remember, a stock can go anywhere and stay there. Volatility can go anywhere, but it can't stay there. It must revert to its mean over time. Understand this can help with buy and sell decisions. All right, when to buy volatility, when to buy premium, and when to sell premium. All right, most traders think mean reversion is an instantaneous thing. All right, it is not. Volatilities can stay low for extremely long periods of time. Extremely long periods of time. See 2012 through 2014 and a half, really kind of through most of 2015. There were periods of time from 2002 till 2007 where volatility stayed extremely low. So the key is vols can get sky high and they can get relatively low. It is important not to have a recency bias with volatility. That is the key. Recency bias kills traders. I get these emails, oh, I just sell premium and I make money. And premium selling can be super effective, but it can also be absolute blow you up. All right. So a recency bias is the bias that what has happened recently will, is the way things are. So when you look back, one must look at, especially with volatility, it's important to look at least a decade of volatility, maybe longer, to truly understand how much an underlying can move. Yeah. So that's the key. So things to understand, remember, when vols are low, when IV is low, it can stay there for a long time. Money can seem easy to make selling premium, but money can go away incredibly fast. I watched during a blow up in August of 2015, I watched a very large money manager that had a 4-year track record of making money blow a third of his assets in about 3 days. Recency bias. All right. So the play is to be long vol, long units, short premium. All right. So when IVs are low, all right, it's important to want to own some premium, be a net owner of contracts, but be a net seller of premium. One can own lots of contracts and still be a net premium seller. That's the key. So things in low volatility environments that can work great are calendar spreads and certain types of modified butterflies. That is really one of the major key, and there are some trades that can work excellent in low volatility periods. The calendar spread from 2012 to about 2015 worked so well. All right, and then obviously long units, it's important to own a few extra contracts because we never know when volatility is going to blow up. And and generally they're inexpensive. But it's important to also be short premium. Those are the keys. So when IVs are high, understand that it will fall back. All right. So until recently, some spikes were short, and then we saw one in August of 2015 where the VIX spiked over 20 for over 2 weeks, near 3. So again, a recency bias. People in 2015 assumed that, well, all of the spikes that have happened in the past are the way they always are, forgetting that in 2011 the VIX was over 20 for 6 months, and in 2008 it was over 20 for about a year. So things that I like in a high volatility environment, because they can stay high for months. I like long VXX and short time spreads. All right. I like long VXX versus short SPY put spreads, using one to finance the other. Short butterflies can work, where I'm long the thorax and short the wings. And shorting those wings can be extremely profitable because they typically get extremely overpriced. Iron condors can work. There can be all sorts of interesting income-producing trades. I am a big fan of selling put spreads and hedging it with some sort of long VXX when volatilities are high. One thing a lot of people forget is that when it comes to volatility, you want to sell low and buy lower, or buy high and sell higher. So now, let's talk about the VIX. It's the SIBO Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500, the SPX. Gauges the cost of insurance. The idea is that when there is more buying over selling, generally the market is trying to buy protection. When there is more selling than buying, the market is not out seeking protection. So when VIX is up, cost of insurance is higher, and vice versa. Similar to the S&P 500, this index is not actually traded. There is not an index, one can't trade one share of the S&P 500. There's spiders, there's all sorts of different things. But unlike the S&P, where futures and spiders track the SPX super closely, there's not even anything that tracks the VIX well. There's not a single instrument that really does a decent job of tracking the VIX itself. Closest thing is the VIX weekly futures. So the VIX is essentially an estimate of implied volatility on the S&P 500 options that has a net duration of 30 days. It's a constant duration. That means it attempts to constantly mimic a portfolio with 30 days to expire. All right, the weighting of the VIX puts more emphasis on at-the-money options, those trading near the underlying. The weighting of the VIX naturally puts more emphasis on out-of-the-money puts than out-of-the-money calls, which is interesting. the VIX uses two weekly options closest to 30 days to expiration. One is equal to or less than 30 days. The other is more than 30 days. Here's the VIX calculation. So if you're looking at October of 2014, it would use the weekly that has 30 days to expiration and the weekly with 37, and then roll between the two of them. So what is the VIX? All right, the VIX is quoted as a price, but is really a percentage. So volatility, despite not being spoken as a percent, is always a percent. Remember this. So a VIX of 30 is 30% annualized. 30% annualized expected movement over the next 30 days. So when the VIX is 20, it is the market of S&P 500 options are saying the SPX is going to move at an annualized volatility of 20% for the next 30 days. That's the key. So let's look at a chart of VIX, all right, versus the SPX. These are returns of the VIX in yellow versus some returns of the S&P over a 2-year period. And what does one notice? When the S&P returns stink, the returns on VIX are great. And when the SPX is doing well, the returns on VIX are not good. All right. So here's another view. All right. The blue line is the S&P. The red line is VIX. On the left is the S&P prices. On the right is VIX prices. And you can see how well the two move against each other. So the VIX negatively correlates with the SPX. When SPX is up, VIX is generally down. When SPX is down, VIX is generally up. This makes sense, as generally when the market sells off, volatility does increase. Right? There's also the nature of similar movement against a lower number. So think about this. If the S&P 500 moves 10 points a day and is priced at 1,000, it's moving 1% a day. If the S&P is 2,000 and moves 10 points a day, it's only moving 0.5% a day. That is much lower. That is a 50% lower volatility, despite the same movement. All right. Now, there are also some additional features of VIX Calc that cause it to increase on a sell-off. One of them is volatility skew. So that construction that we talked about causes the VIX to rally when the market falls and then fall when the market rallies. It's caused by volatility skew. All right. So now moving on to VIX options and futures. VIX options and futures are not options on the cash VIX that is often quoted on TV. There are no options on that cash VIX. All right. VIX futures and options on the forward future value of VIX. So they're on a forward value of VIX, not the VIX itself. This means they are an option on a volatility swap, not VIX. So thus, VIX futures and options will trail the movement of the VIX both up and down due to the assumption of mean reversion. So when the VIX is exceedingly low, VIX options and VIX futures assume that the VIX is going to rally. When VIX is extremely high, VIX options and futures assume that the VIX is going to revert back. So they trail. So, for instance, in August of 2015, there was a period of time where the cash VIX was trading at a 15-point premium to the cash VIX number. All right, that's the key. So this is what the VIX futures curve looks like most of the time, where the cash VIX trades below the at-the-money, or trades below the front month future, which trades below the second month future, which trades below the third month future, and so on, and so on, and so on. All right, this is this term structure here represents a calm market, a logical market. This was the pricing on August 31st, 2015. September trading above October, October above November, November above December, and then a relatively flat back end of the curve. This is a sign of serious market stress and is unusual, extremely unusual. So when this is what's going on, things are bad. All right. One thing that's interesting, if we've done lots of studies on the VIX, and if all you did since they listed VIX futures is go to cash when VIX futures enter what's called backwardation, this structure, you would outperform the S&P 500 by more than 100%. Because when the VIX is backward, it is a sign that things are wrong in the market. So now you're saying to yourself, hey, I don't have futures. There are lots of groups that don't, there are lots of systems that have VIX options but don't have the future that is the actual options underlying. All right, so options, the real underlying for the option is the future. So you have to use, if you don't have VIX futures on your trading platform, you have to use a combo. So all you do is take the call bid plus the strike minus the put ask, and that will give you the future. So in this case, if you took September and you took the 26 strike and you took 270 plus 26 minus 4.5, the future price for the September contract is 24.20. Very simple. All right, so VIX options and futures are European exercise. This means they cannot be exercised early. All right, they have a unique settlement process they have a unique settlement process, and basically they have the same settlement procedure as the futures. It's based on VIX Mo, not on VIX itself. At 30 days to expiration, a VIX future will have a beta of to the cash VIX typically of about 0.5. So it'll be 50% as volatile. As time passes, it gets more and more beta to the VIX. And of course, weekly VIX futures have generally, especially the front month, has a high beta, typically north of 0.7. And again, there's that understanding to recognize. So right now, if you look, September on this is moving the closest to October, to how the cash is moving. October is moving less than September, and so on. That is what causes this. All right, so now the VIX futures are the most successful future product probably listed in the last 20 years. They trade out 8 months. Each month trades independently, not like the structure of SPX, which is based solely on carrying costs. So each future trades completely independently of the other one. It's much more similar to trading different corn cycles or wheat cycles or things like that than it is like trading a financial contract, because every future is so different. They have listed weekly futures. Those are going to trade. They're in Contango 80% of the time. So we see VIX futures where they are priced above the cash index about 80% of the time. All right, and they're typically used for hedges against long portfolios. The VIX options are the most successful option product in the last 20 years. All right, really since SPX. They trade out 8 months. Each month, again, trades independently. All right, the underlying future of that month is the underlying instrument for the option. All right, they're listing weekly options on 10/8 of 2015. Underlying is the future, not cash, typically used as hedges against a long portfolio. The volume of VIX options. VIX options are super, super liquid. They, on a slow day, they will trade 400,000 to 500,000 contracts. On a busy day, they can trade 2 million. So the only other kind of index contract that does that kind of volume is the S&P 500, the SPX. So the trade is over hybrid and open outcry. So it's about 60% of it trades electronically, about 40% of it trades in open outcry. Most of the big orders trade in open outcry. All right. Markets are generally relatively tight in the near term. So I typically see VIX spreads no wider than a dime going out multiple months. So the nice thing is they're super, super liquid. So this is a snapshot from a relatively busy day. And, just looking down at some of the volume down here, you can see relatively big lots trading, 10,000, 10,000, 10,000, 9,000, 9,000, 7,500 here, and near 1 million contracts trading. All right, so now let's talk about the volatility. All right, the VIX of VIX options is the VVIX. All right, it can often seem very low relative to VIX. Again, this is because the option volatility is more based on movement in VIX futures instead of the VIX options. Futures realized volatility is almost always significantly lower than the cash. VVIX will trade as low as the 60s in slow periods, and it can get as high as 200 when VIX is high and the market is in panic. 200. So the VVIX, that 30-day, so the VIX of VIX, so an annualized volatility of the next 30 days on VIX. So a 200 volatility says that the likelihood is that VIX will triple itself and or fall by triple, if you think about that, in the next year on an annualized basis. As SPX is tanking, VIX made year highs. That is a thing to understand. All right, so VIX is making highs, VVIX is making highs. So, VIX oppositely correlates with the SPX. When the SPX is rising, VIX is falling, and vice versa. VVIX positively correlates with VIX, generally. There's some crazy, this is a snapshot of the flash crash in August of 2015, where volatility in VVIX got into the 200s. Absolute nightmare. And VIX, of course, touched 53, its highest level since the 2008 level. And again, one can see that it backed off. All right, so unlike the VIX, relative to SPX, the VIX and VVIX are positively correlated. When VIX is rallying, the VVIX is typically going higher, especially when the VIX is moving from below its mean back toward its mean. When the VIX is popping, the VVIX is not. That can be a sign that smart paper is selling insurance rather than buying it. All right, so if VIX is up big and VVIX is not, smart money may be saying that VIX is overpriced. This is a chart of how VVIX has popped in the past. Little pop of VIX, little pop of VVIX, and then right back down. So those spikes in this time period were relatively easy sales. All right. Term structure. Unlike many equity products, typically near month implied volatility is higher than the months further out. This is partially because each month, again, has its own underlying. And the most volatile underlying is that front month. All right. There's delta in the future movement. Since those future ones aren't moving as much, all right, there is typically a lower volatility back there. That's why it can seem with VIX, it is typical in VIX to be able to buy calendars and calendar spreads for a credit. It is not atypical to see that. And that is due to this volatility and due to the fact that the futures are moving around in different areas. So again, you have to remember, every month has its own underlying. And so if you're in a situation where you're looking at an at-the-money put spread and you're doing January versus October, all right, you're doing a put time spread. If I buy a January put that's at, somewhere around, let's say I do the 17 put spread, well, my January put is an out-of-the-money put, and my October put is an in-the-money put. There's a $1.20 difference between that underlying. October may be more expensive than January. That doesn't mean I want to do that trade. And likewise, right now, in this picture, September, again, is trading at a premium to October. So if I do a 25 calendar spread in calls, my October calls are out of the money. My September calls are in the money. It is entirely possible that my time spread, again, trades for a credit. Something that is unheard of in just about any financial instrument other than VIX. So each option trades versus the future that expires in the same months. All right, so there's huge risk in time spreads. Because each option has its own underlying, many firms do not offer a margin discount on calendars and time spreads in VIX. In fact, most don't. All right, now, because VIX options have a different underlying, it's entirely possible, again, to do that long calendar for a credit. So now looking at term structure, again, notice May is trading at a large premium to June. But as the months move further out, the levels begin to converge. So you see a big pop. May volatility is much bigger than June, which is much bigger than July. But some of the longer term stuff, not a problem. All right, so now, normally index have what's called a backward skew, which means puts are more expensive than calls. Sometimes it's called an investment skew. The skew is caused primarily by hedging activities and collaring. All right, so if you think about it, the whole world is long puts because the whole world is long equities. VIX is the opposite. So all right, so just be aware that when skew is bid, all right, when the skew is bid to where the crash will be, all right, and VIX options, as one raises strike prices, the implied volatility increases. So there are some things that we can work to make to our advantage using VIX, and we're going to talk about how to build some trades. All right, so recall that the VIX options at the money strike is not the cash VIX level, but the futures. So at the money is 25, at the money for ACK is 22.70, and at the money for Nova is 22.05. All right, so trading long with Contango. All right, so recall that VIX futures are normally in Contango. That creates almost a second negative theta as futures converge to cash. All right, people talk about the ETNs and how bad they are, and it is entirely caused by Contango. So part of the reasons why VXX and UVXY have sullied names is because Contango naturally causes them to lose value. Just like a VIX future in a Contango environment naturally loses money every day. So there's a theta to owning options in a contangoed environment. All right. However, VIX does have a favorable forward skew that the trader can take advantage of. So let's look at how I can build some trades. So trading long. All right. When using options to trade a higher VIX, typically the most favorable one is the slightly in the money or at the money call. All right. An even more favorable trade is a call debit spread. So buying a call that is at the money and selling an out of the money call can allow for bullish verticals with favorable risk reward. Setting up hedges in VIX, call spreads are the best way to do it. All right, for the simplest way to do it for a lot of people. All right, there are other trades like back spreads that can also make sense, but you know, with the VIX at 14.25, so the VIX is 14.25. In this case, I can buy a 17.22 call spread, so a 5-point vertical, for less than 40 cents. So it's a spread that pays $4.60 against a 40-cent bet, and at a level where if the market gets stressed out, 17 is almost always comes into play, and 22 does not always come into play. So you're getting long, you're getting short above 20 and long below 20. That's really the way these hedges can work. And you know, this spread is just so cheap. All right. I mean, the market was $1.35, so really 30 cents. This is just, and so being able to set up inexpensive hedges like that, it is just extremely cheap to use as a trade. And one of the nice things is, you know, we'll talk is this sticky strike that I'm going to get to. So the other thing one can do is short puts. Remember, the VIX has a 4, all right? While it can go super high, it can't get super low. The VIX has been below 10, I believe, a total of 9 days in its history. All right. So thus, the credit might be small, but it has a really positive expectancy. All right. VIX put selling has a super positive expectancy when the VIX is low. And you know what a lot of people can do is trade VIX. All right, short VIX against long, you know, against short VIX puts against long VIX calls as a financing play for a hedge. So if I do a call spread versus a short put, I can sometimes put that thing on for even money or better. All right, so trading short with Contango. While a trader usually has Contango in his or her face when trading from the long side, the way I like to trade VIX, especially in a Contangoed environment, is from the short side. It makes outright puts that are at the money or in the money super favorable. All right? The further the out of the money put is, the lower the IV. So owning a long put will have some favorable characteristics in a falling and stable environment. I love owning puts most of the time in VIX. All right, so one thing to look at these bear puts. All right, notice a 2-point vertical in a put spread. Costs about as much as the 5-point vertical does in the call spread. Or more. So that skew can work to your advantage, but the way they just destroy volatility on the low end. I mean, on the left side, one can see like above 17, volatility takes off to over 100, implied volatility. Where on as puts, as we get below 15, that volatility just craters. So with the VIX, remember the VIX is about 14.25 in this picture, and the 14-12 put spread is more expensive than the 17-22 put spread. It's more expensive than the 15-18 call spread. All right, all right, so playing VIX Pops. All right, so this is an old one from 12/20, went from 12/28/2012, and this is right as traders are worried that Congress might bail on is the U.S. going to quote unquote default? And so when the VIX truly pops, a trade that many people like to do is called a 1x2. What traders can do, so look, the VIX is trading 22.72 here. I can buy the 21 calls for $3 that are in the money by $1.75. And against it, I can sell 2 of the 26 calls at $1.50. So net, I don't pay anything for this spread. I'm selling options that are out of the money against buying options that are in the money. And I'm not paying for it. This trade will quickly make dollars when pops subside. So you can see this is 12/31. So we put the trade on for even, and on 12/31, the 21 calls are 70 cents, and those 26 calls are 30. I can flip back out of it at a dime if I want. That's the value. And when VIX really blows up, there could be some serious dough. And there are other ways to structure this, but I love playing VIX Pops that way. Now, a trade I love doing, again, is bear 1x2 put spreads. Again, recall that VIX has that floor. So what if I bought the 13 put and sold 2 of the 12.5s? My net credit, if I did 30 cents and a quarter, 30 cents and or 35 and 20, or 30 and 20, however I want to do it, or 30 and 22.5, whatever. I'm going to break even about 11.85, and I took in a credit. And what's even better is if VIX does slowly drop, I can make a lot of money as it eases lower. This is one of my favorite trades in VIX. All right, so now let's talk about hedging. All right, the VIX is, as many of you know, a hedging vehicle. The calculation is directly related to how variance swaps trades in the over-the-counter market. A variance swap is an OTC trade so you can't trade OTC. So the VIX exists to basically for people to trade against the OTC swap. So there are lots of circumstances where SPX or SPY is better hedging than a long equity. There are times where VIX does a much better job. So VIX is hedge. If one were using a near-term hedge, the VIX could potentially work better, depending on the timing. Basically, one of the keys is VIX has a sticky strike. So if one is hedging a far out in a bull market, is going to work better since strikes get too far away. So think about this. In this latest market, so let's say at the beginning of the year I bought S&P 500 puts against my long stock portfolio. All right, and at one point the S&P was up 8%. I had to wait for the S&P to drop 8% for my put to really start working. Whereas VIX, if I'd hedged with like a long-term VIX 17 call, that sticky strike would have started working right away. All right. So VIX as a hedge is great. So this is a 6-month chart. One can see that it can take a while for VIX to work, but once it works, it can really work. I mean, VIX options that traded out really well. Okay. So VIX versus SPX. What is the major issue of using VIX as a hedge? And that's backwardation and Contango. If I buy a VIX $18 call expiring in October, it is highly unlikely the VIX will be able to move far enough out of the money that the strike no longer hedges. All right. So whereas a sharp move in the SPX, the strike can stop hedging. So what is a major issue of the SPX? That sticky strike again. All right. If I buy a VIX $18 call expiring in May, it is highly unlikely that, again, the VIX will be able to move away. When SPX moves from, so the VIX can go to 12, but it can't go to like 0. All right. And so one thing to remember is at the beginning of the year, the S&P was around 1950 and the VIX is at 12. And here we are, we're around 1950 and the VIX is 26. But in 2014, the market gained 10% and the VIX stayed at about the same price the entire time. So if I bought a long-term $15 call in VIX, you know, up until the day of expiration, that call could have worked really well. So here's just kind of an interesting thing to look at. All right, so on July 14th, the VIX is hitting year lows. The OCC futures is around 1680, and SPX is around 2104. All right, how did that move? All right, the VIX OCC 16 call goes from 2.5 to 8.5, with the future going from 6 to about 2260. All right, so that call, all right, that call more than tripled in value. That's nice. Meanwhile, that Jan 1950 put doubles in value. So the VIX, if you did it on a dollar neutral basis, just absolutely just murders your hedge in SPX. So, you know, there are other smart ways to do this, but, you know, those are the things that I'm looking at. And so recall how I explained to trade VIX long from the speculative side. Why in the world would I treat a hedge and trade any different? All right, the only major difference, I might leg the call spread on a hedge trade. So I buy VIX calls when the VIX is low, I sit and wait. All right, when the underlying rallies a point or two, I then will execute the spread. So I'll buy low and then I'll sell higher. Okay. So in summary, VIX options have unique characteristics. Each has their own underlying. IV and VIX are both correlated, bear and bull plays, and play the strikes. All right. Now, I'm going to give you my offer, and then I'm going to show you a couple of trades I'm doing right now. Okay? So on Saturday, a week from Saturday, I'm doing a full 4-day, oh, does it say, where does it say strikes? Andrew and I are doing a 4-hour course on volatility VIX and the VIX ETPs. Andrew's going to go first. He's going to talk about the VIX ETPs in detail for about 2 hours straight, and then I'm going to dig into VIX, and we're going to have a ton of fun looking at it. All right. Now, you go to optionpit.com/VIX primer, and if you use code 25_off, it's already cheap at $147. It'll take an extra 25 bucks off. This code expires on Friday. All right. This code expires on Friday. So, I would encourage all of you to go here, optionpit.com/VIX primer, to take this course. Yeah, so if you took the VIX class last year, you're gonna get a lot more. How do you get the strategy letter? You can subscribe to optionpit.com, and and that runs through our, that's our OptionPit Live service. All right. So that's our subscription service. What are our chat times? Andrew and I are typically on for a couple hours in the morning. Then we do the pit report in the middle of the day, and then we'll do like a little wrap up. So I try to be on for at least an hour a day, typically an hour and a half. This class is recorded. I'll email it out. But and the one on Saturday the Saturday class will be recorded as well. All right. That's what I'm here for. All right, guys. Everybody get signed up for the class, and I hope everybody has a great evening. If you've got questions, feel free to email me. All right, everybody have a great day.